The 2026 recession may be closer than most people think, but here's the part that rarely gets said out loud. Downturns are where real wealth is built. Right now, something strange is happening. By official numbers, the economy is still growing. GDP projections are hovering a little above 2%, which on paper looks stable. But step outside the data and talk to real people, and a completely different story shows up. Nearly 3 out of 5 Americans already feel like the economy is in a recession, not heading toward one, already in one. That disconnect matters more than it seems. Because economies don't just run on numbers, they run on behavior. And behavior is driven by perception. When people feel uncertain, they stop spending. When spending slows down, businesses feel it almost immediately. Revenue drops, hiring freezes, layoffs begin. Then the cycle feeds itself. Less income leads to less spending, which leads to more pressure on businesses. And suddenly what felt like a maybe turns into something very real. And the signals aren't subtle anymore. Major institutions are already raising flags. Global banks are putting recession odds as high as 35%. Federal Reserve models show meaningful probability of a downturn before the end of 2026. At the same time, 3 out of 4 investors are already bracing for a major market drop. That's not a fringe opinion. That's the majority. Now layer on top of that what's happening beneath the surface. Corporate debt is sitting at historic highs. For years, companies borrowed aggressively when interest rates were low. That worked until rates climbed. Now those same debts are becoming expensive to maintain. When companies struggle to service debt, the easiest lever to pull is cutting costs. And the biggest cost on most balance sheets is people. That's why layoffs tend to cluster right before and during recessions. At the same time, consumer savings are shrinking. People are spending more and saving less. That creates a fragile environment where even a small shock can trigger a much larger reaction. When households don't have a cushion, spending drops faster, and that drop hits businesses hard. Then there's the bond market quietly signaling trouble. An inverted yield curve has historically been one of the most reliable predictors of recession over the past 50 years. When short-term bonds yield more than long-term ones, it signals that investors expect weaker conditions ahead. It's not loud, it doesn't trend on social media, but it has a track record that's hard to ignore. And then there's behavior. Overvalued assets getting massive attention, speculative bets becoming mainstream conversation, people with little experience jumping into markets expecting quick gains. That pattern has shown up before every major downturn, from the dot-com bubble to 2008. Put all of this together, and a clear picture forms. Not certainty, but vulnerability. And this is exactly where most people go wrong. Because when uncertainty rises, the default reaction is panic. Pull money out, sell positions, move everything to cash, wait for things to feel safe again. That instinct feels logical in the moment, but historically, it has been one of the most expensive decisions an investor can make, because markets don't recover when things feel comfortable. They recover when things still feel uncertain. And the biggest gains tend to happen in very short windows, often right after the worst declines. Missing just a handful of the best days in the market over decades can cut total returns dramatically. A long-term investment that could grow into over $1 million can shrink to a fraction of that simply by stepping out at the wrong time. That's the trap. And it's exactly why a recession doesn't just divide the market. It divides investors. On one side are those reacting emotionally, selling during the drop, locking in losses, and waiting too long to get back in. On the other side are those following a system, a simple but disciplined approach that works across cycles. 3 phases, that's all it comes down to. What happens before the crash, what happens during the crash, and what happens after. Because recessions aren't random chaos, they tend to follow patterns. And once those patterns are understood, they can be used. The first phase is already happening. This is the build-up phase. It's the quiet stage where everything still looks relatively stable on the surface. Markets may even be near highs. Spending continues. Headlines remain mixed. Most people believe things will be fine. But underneath, the cracks are forming. This is not the moment to panic. This is the moment to prepare. And preparation doesn't mean guessing the exact timing of a downturn. That's nearly impossible to do consistently. What matters is building a position that can handle volatility without breaking. It starts with something simple but often ignored: risk. Not theoretical risk, real risk. How much volatility can actually be tolerated without making emotional decisions? Because it's easy to feel comfortable when markets are rising. It's much harder when a portfolio drops 30% or 40%. And those kinds of drawdowns are not unusual during major downturns. If that kind of drop would trigger panic, then the current risk level is too high. That's where adjustments begin. Not by abandoning the market, but by shaping exposure more intelligently. Diversification plays a major role here. Concentrated positions can perform well during bull markets, but they also carry the risk of significant losses if a specific sector gets hit hard. And during recessions, different sectors behave very differently. In one downturn, financial stocks may collapse. In another, travel and hospitality might take the biggest hit. Meanwhile, sectors like consumer staples or healthcare often hold up better because demand for their products remains steady regardless of economic conditions. That's why spreading investments across sectors and asset classes becomes critical. Broad market index funds already provide a level of diversification, covering hundreds or even thousands of companies. But adding other elements can strengthen the structure. This is where bonds come into play. Bond ETFs, like those tracking the total bond market, often act as stabilizers. When stocks fall, money tends to flow into bonds, which can push bond prices up or at least help them hold steady. That creates a counterbalance in the portfolio. It doesn't eliminate losses entirely, but it reduces the severity. Think of it as a shock absorber. Then there are low volatility equity funds. These are designed to include stocks that historically fluctuate less during turbulent periods. They still provide exposure to the market, but with smoother movement. And then defensive sectors, companies that sell essentials, food, household products, healthcare services. These businesses tend to maintain demand even when spending drops elsewhere. People might delay buying a new car or cancel a vacation, but they don't stop buying groceries or basic necessities. Layering these elements into a portfolio before a downturn creates resilience. But structure alone isn't enough. Liquidity matters just as much. And this is where one of the most important preparation steps comes in: cash reserves. Not just an emergency fund. Although that's the foundation, the standard advice has always been 3 to 6 months of living expenses. But during a recession, that baseline often needs to shift upward. Because job markets change. In a strong economy, finding a new job might take a few weeks. In a downturn, it can stretch to several months, sometimes longer. That's why leaning towards 6 to 12 months of expenses creates a stronger buffer, and where that money is held matters. Traditional savings accounts often provide minimal returns. Meanwhile, high-yield savings accounts, money market funds, and short-term government securities like treasury bills offer better yields while keeping funds accessible. That means cash isn't just sitting idle, it's still working. And beyond the emergency fund, there's another layer: strategic cash. Money set aside specifically for investing during a downturn. Because when markets fall, assets don't just lose value, they go on sale. And having capital ready during that window creates opportunity. Without it, the only option is watching from the sidelines. Another key piece of preparation is reducing financial pressure. High-interest debt becomes significantly more dangerous during uncertain periods. Credit card interest rates often exceed 20%, which means balances grow quickly if left unchecked. Paying down high-interest debt before a downturn effectively creates a guaranteed return by eliminating that cost. And it reduces vulnerability, because during a recession, income can become less predictable, while borrowing becomes more expensive. Lower debt equals more flexibility. And flexibility is what allows better decisions under pressure. Then there's leverage. Borrowing money to invest can amplify gains in a rising market, but it also magnifies losses during declines. If asset values drop significantly, forced selling can occur at the worst possible time. That's why reducing or eliminating leverage before a downturn is one of the most protective moves available. It removes the risk of being forced out of positions during volatility. All of these steps, adjusting risk, diversifying, building cash reserves, managing debt, are not about avoiding losses entirely. That's not realistic. They're about avoiding catastrophic losses. Because the goal isn't to predict every movement. The goal is to stay in the game. And that's what sets the stage for the next phase. Because when the downturn actually arrives, everything changes. When the crash actually begins, it doesn't feel like an opportunity. It feels like everything is breaking at once. Prices start falling faster than expected. Headlines turn aggressive. Every news cycle amplifies fear. Words like collapse, crisis, and meltdown get repeated over and over again. And suddenly, what looked like a controlled slowdown turns into something much more emotional. This is the phase where most people lose money, not because they picked the wrong investments, but because they react the wrong way. The second phase is the crash itself, and the defining feature of this phase isn't just falling prices, it's panic. Portfolios can drop 20%, 30%, sometimes even 40% or more, depending on the severity of the downturn. That kind of drawdown hits differently when it's real money on the line. Numbers on a screen start to feel personal. Every red day feels heavier than the last. And this is exactly where discipline becomes more valuable than knowledge. PAR, because the instinct during this phase is almost always the same. Sell, move to cash, stop the bleeding, wait until things stabilize. But historically, that reaction has created more damage than the downturn itself, because the market doesn't wait for comfort. It doesn't send a signal saying the worst is over. Recovery begins while uncertainty is still high, and the strongest days in the market, the ones responsible for a huge portion of long-term gains, often show up right in the middle of that uncertainty. Data going back decades shows that missing just a small number of the best-performing days can dramatically reduce total returns. A long-term investment in the S&P 500 that stays fully invested can grow exponentially over time. But remove just a handful of those best days, and the final outcome drops significantly. And here's the catch. Those best days usually happen very close to the worst days. They cluster together. So exiting during the crash doesn't just lock in losses, it almost guarantees missing the recovery. That's why staying invested is not just a suggestion, it's a core principle. But staying invested doesn't mean doing nothing. There's a difference between passive behavior and strategic action, because while most people are selling during a downturn, a smaller group is doing something very different. They're buying. Not all at once, not trying to predict the exact bottom, but consistently. This is where one of the most effective strategies comes into play: dollar cost averaging. Instead of investing a large amount at a single point, a fixed amount is invested at regular intervals, regardless of market conditions. When prices are high, that fixed amount buys fewer shares. When prices fall, it buys more. And during a downturn, that dynamic becomes extremely powerful. As prices fall, each dollar invested begins to work harder. Picture a broad market fund priced at $400 per share. A $200 investment secures half a share. If the market drops and the price falls to $200, that same $200 now buys one full share. If it declines further to $100, the same amount buys 2 shares. Over time, this process lowers the average cost and builds a stronger position for the eventual rebound. And markets do recover. History has shown that repeatedly. The real driver of long-term wealth during downturns isn't perfect timing or guessing the bottom. It's steady, consistent investing through uncertainty. Preparation makes this possible. Having cash reserves creates flexibility. Instead of reacting with fear, there's room to act deliberately. Cash becomes a tool, allowing entry into opportunities not only in stocks but across assets, like real estate or undervalued sectors. Still, strategy alone isn't enough. Emotional control matters just as much. Constantly watching losses can trigger poor decisions. Staying consistent, reducing noise, and focusing on long-term goals turns volatility from a threat into an advantage. That disconnect creates hesitation, and hesitation can be costly, because by the time confidence fully returns, a significant portion of the recovery has already happened. This is where the earlier phases come together, because the combination of staying invested and buying during the downturn creates leverage in the recovery, not through borrowing, but through positioning. Consider a simplified example. A portfolio starts with $10,000 invested in the market. A downturn causes a 40% decline, bringing the value down to $6,000. That loss feels significant, but instead of selling, the position is held. At the same time, an additional $3,000, set aside during the preparation phase, is gradually invested throughout the downturn. As the market recovers and returns to previous levels, the original investment climbs back to $10,000, but the additional investments made at lower prices appreciate even more. That $3,000 invested during the downturn could grow to $5,000 or more depending on entry points. Now the total portfolio sits around $15,000 instead of just recovering to $10,000. That difference is the result of strategy, not luck. And historically, recoveries have extended beyond previous highs. After the 2008 financial crisis, markets didn't just recover, they entered one of the longest bull runs in history. The same pattern followed the dot-com crash and the 2020 pandemic downturn. Each time, those who stayed invested recovered. Those who invested during the downturn gained even more. And those who exited struggled to catch back up, because re-entry is harder than exit. Fear keeps people out longer than logic would suggest. That's why the final phase isn't just about holding, it's about continuing to deploy capital intelligently, rebalancing portfolios, maintaining diversification, and gradually shifting focus back toward growth as conditions stabilize. But the core principle remains the same across all three phases. Preparation creates resilience, discipline creates opportunity, and time amplifies both. Recessions are not anomalies, they are part of the cycle. Corrections happen regularly. Bear markets show up every few years, and deeper downturns, while less frequent, still follow patterns that repeat over time. The difference is not in predicting them perfectly, it's in responding to them correctly. Because at the end of the cycle, outcomes tend to split into clear groups. Those who panic and lock in losses, those who stay invested and recover, and those who prepare, act, and come out ahead. And the gap between those outcomes can be massive, which brings everything back to a simple idea. A recession is not just a risk, it's a filter. It exposes weak strategies and rewards strong ones. And the strategy that consistently works follows a structure. Prepare before the downturn begins, stay disciplined and invest during the panic, and position for growth during the recovery. That's how a recession-proof portfolio is built, not by avoiding downturns, but by using them. If this breakdown helped bring clarity, make sure to support the channel by liking the video and subscribing for more content like this. More insights and strategies are coming, and staying informed during uncertain times can make all the difference.